Test, test, 1, 2, 1, 2, 3, 4. Ça c'est très bien. Test, test, 1, 2, 1, 2, 3, 4. C'est bon? Test, test, 1, 2, 1, 2, 3, 4. Numéro 4. Test, test, 1, 2, 1, 2, 3, 4. Un peu trop fort. Test, test, 1, 2, 1, 2, 3, 4. Test, test, 1, 2, 1, 2. C'est bon. Numéro 5. Test, test, 1, 2, 1, 2, 3, 4. Test, test. Test, test. Test, test, 1, 2, 1, 2, 3, 4. Test, test, 1, 2, 1, 2. Test, test, 1, 2. Siffle un tout petit peu. Ouais. Test, test, 1, 2, 1, 2, 1, 2, 3, 4. C'est bon. Ouais. Vitre. Test, test, 1, 2, 1, 2. Test, test, 1, 2, 1, 2, 3. Test, test, 1, 2, 3, 4. Test, test, 1, 2, 1, 2, 3, 4. Ça, c'est bon. Qu'est-ce que t'as encore? 2 micro-mains?
Ouais, ça, ils sont ici. Je ne sais plus où il est, mais bon. 1, 2, 3, 4, essai. Hey, hey. Ya. 1, 2. OK. Et le deuxième, comme ça, je vais changer aussi la batterie.
Test, test, 1, 2, 1, 2, 3, 4. Il siffle un peu.
Il siffle, c'est lequel? C'est le deuxième fait?
Test, test, 1, 2, 1, 2, 3, 4. Test. Test, 1, 2, 1, 2, 1, 2, 3, 4. Test, test, 1, 2.
C'est hey. Ya. Et 1, 2, 3. Et hey. Ça. Et ya. 1, 2, 3, 4. C'est micro. 1, 2, 3. C'est hey. Ya. 1, 2, check. Hey. 1, 2, 3. C'est micro. 1, 2, 3, 4. 1, 2, 1, 2, 1, 2, 1, 2, 3. C'est hey. 1, 2, 1, 2, 1, 2, 1, 2, 3. C'est micro. Et ça, c'est le numéro 1, 1, 2. Quel numéro c'est là? 1, 2, 3, 4, 1, 2. Ah ouais, mais c'est ici. 1, 2, 3, 517. Le 517, il n'y a pas de scotch ici à l'arrière. La pause de sensibilité, je veux dire. 1, 2, 3, 1, 2, 3. Et ça, c'est le tien. Il allait bien, lui. Hein?
Test, ouais. Test, 1, 2. Non, il siffle. Test, test, 1, 2, 1, 2, 3, 4. Impeccable.
Voilà. Bon, ben voilà. Hein. OK. 1, 2, 1, 2, 1, 2. C'est par contre celui-ci, la sensibilité, je ne vais regarder parce que là, c'est... Oh oui, mais il est à plus 6 dB, il faut le descendre. Aïe, 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 aïe. Attends. Le squelch, alors qu'est-ce qu'on a? C'est où est-ce qu'on va dans le truc? Non, pas le scotch. Je dois aller dans... Non, à 27 kg. Pour le faire, à moins. Ouais. Est-ce que j'ai même pas fréquence preset? Non, c'est pas ça. Non. Écoliseur? Non. 1, 2, 3. 1, 2. Non. Non. Warning, non. Non. Ah, il a le 15 dB. 1, 2, 1, 2. Regarde un peu. Vas-y. Et on va diminuer un peu. Ça, là. Pousse une fois dessus. Hop. 0 dB. Ah, voilà, tiens. Moins 6 dB. Ok, ça c'est mieux. Ah,
Test,
salut.
test, 1, 2, 1, 2.
1, 1, 2, 1, 2, 1, 2, 3. Lequel? Celui-là, il faut faire plus fort.
about 2 o'clock.
Yeah,
You
that's
are
fine.
informed.
Yeah.
So I speak from here. Makes
Yeah, that's
sense.
fine. Yeah, that's fine. We usually have these food for thoughts in the market centre.
Okay, okay.
That's such,
There's a lot of people here.
it's the most
They're all here to hear Marcus. They want to hear what Marcus has to say about Capital Markets Union. That's why your audience have come to listen to you.
No, they come to you. They want to know where to invest the money in the
Welcome,
future.
Asia.
participate in this kind of events.
it's a very popular issue, I think.
Yeah, well, yes, exactly, and it will be more once the people will be
Yeah,
200 people had signed.
I think we underestimated the
the
investments
time.
there already. We thought maybe it would come later in
It's
the
because
year.
of Maite. They want to get them. Maite, they are all because of you here.
Yes, it's
Because they want
MiFID
to,
level
Last
two.
opportunity.
to get a preprint of the Green Book.
Yeah, well, that will happen already last week with Vice President.
You don't have it with you?
No. But you might have got it already, so. But it's a draft, so.
Yeah.
Do you know
Yeah.
Marcus who works with me? Have you seen him?
I don't know what he looks like.
So, dear friends, welcome to our Food for Thought debate on financial market regulation and capital markets union. As you well know, we normally have our debates, lunchtime debates in our conference room next door, but what happened is that since we put the invitation out, in less than 12 hours we had 160 confirmations, so that's why this exceptional venue. I hope that the sandwiches here were at least as good as in our office. So why are we here? We are here because Juncker's Commission, for them, the single market is an essential issue which they are pushing forward. And linked to that, as one of four freedoms, is the capital markets union. Commission is very clearly stated that it's that the capital markets union is part of the essential part of the single market project, saying that it's up to 28 member states, member countries, to create the capital market union for 28. We are now having several proposals. Green paper is coming out. Also, we are looking forward to the action plan in third quarter of 2015. Also, the respective commissioner, Commissioner Hill, has many times in many speeches underlined that if the last 5 years in financial market regulation was about stabilizing the European economy and market, next 5 years would be really in order to cap or to tap into potential for the European companies and SMEs. But we know that vision is very far from reality. In fact, the European capital markets is very much fragmented. There's many implications and consequences because of that. One example is that in Europe, essentially, for lending, 80% of all lending for private and private companies goes through banking sector, whereas in the United States the same number is 20. The rest being equity, venture capital and money market funds. So being one aspect. Additionally, we have challenges, other challenges, different national legal frameworks treat different financial instruments in a different way. There is differences in insolvency laws, and also there is no proper pan-European risk assessment mechanism for smaller firms. But as is in essence, one of the more ambitious goals for capital markets union is to kind of expand this non-banking segment and make it more accessible for companies. In this debate today, we essentially focus on ongoing legislation, basically related to banking union, directive on markets and financial instruments, and of course money market funds legislation. What we try to do is a little bit find a balance between the technical aspects of that debate and see it in the more political impact framework. In other words, we try to have that this debate is not too technical. So in essence, to conclude, Capital Markets Union lies on two pillars, essentially banking union and financial market regulation. And as we know, as we see, both those pillars are very much under construction. And from that, we can estimate that it will take a while before we have the CMU together. But the main point, I think, of this whole debate, and I think that's the reason why so many of us are here, is that when the Capital Markets Union will become it will be a real game changer. It will really change how the whole financial sector will move and operate in Europe, and then hopefully have very big positive impact on European economy. So I want to welcome you. I want to thank the panelists, and I will give the floor to Andra, who is the economist of Martens Center, who has been working hard to get this meeting together, and he will introduce the panelists and also will moderate the debate. So, welcome.
Thank you, Tommy. As Tommy said, my name is Dr. Andre. I'm the economist in the Martens Center. I suppose Tommy has set the scene nicely for this debate. What we wanted to do in this debate also was to bring together the various strands of Capital Markets Union. It's not one simple initiative, but a set of interlinked initiatives which goes all the way from financial market regulation to solvency laws in member states. I think the timing of this event is important. The College of Commissioners had their first orientation meeting last week on Capital Markets Union. A green paper is expected in the coming weeks with an action plan by the end of the year. At this point, I'll simply introduce our speakers and start the debate. To my very right is Markus Ferber, MEP, well known in Brussels.
Not a political estimation.
Vice Chair of the Econ Committee in the European Parliament, and he was rapporteur on the MiFID II legislation, which successfully came through the European Parliament in 2014. On my direct right is Brian Hayes, MEP, again another member of the Econ Committee. He's former Minister of State for Finance and the Office of Public Works in the Irish Government, and he is, I believe, shadow rapporteur on the money market funds legislation, which will be making its way through the Parliament. On my direct left is Maria Teresa Fabregas Fernandez. She's head of unit in the recently renamed DG Financial Stability, Financial Services and Capital Markets Union, and she's in charge of a unit dealing with securities market. And on my far left is Dr. Diego Valiente, head of Capital Markets Research in CEPS, and I think it's fair to say a long-term advocate for Capital Markets Union in the European Union. Just before we start, as Tommy mentioned, the food for thought concept, we tend to run it in smaller formats in the Martens Center, so we're hoping that this format will translate to this slightly bigger audience. The speakers have been allocated 5 to 10 minutes, 10 minutes max, to make their contributions, and once their contributions are finished, we will directly open the debate to the floor and let the debate be guided by questions from the audience. At this stage, I'm very happy to give the floor to Markus Ferber, MEP.
Yeah, thank you very much, ladies and gentlemen, for having the honor of speaking here with you and discussing something which reminds me on Mark Twain, who once said, everybody talks about the weather, but nobody does anything about it. And sometimes I have the feeling when Jean-Claude Juncker introduced the phrase, let's build a capital market union, it's like speaking about the weather. Everyone speaks about it, but no one knows how to intervene. And therefore I hope we get some light in this darkness or CMU really will be. On the other hand, the European Parliament, especially in the last legislative period, has done a lot of work in financial market regulation, and I only want to bring that back in mind, that we are not at a starting point. We have done already a lot of things. We are in the process of establishing all these things, and the Commission knows when I speak about level 2 measurements, for example, which will be one of the big issues in the European Parliament and in the Econ Committee. I think firstly we had to introduce European institutions to safeguard European approaches and supervisory mechanisms. Only to remind you on EBA, ESMA, and EIOPA, which have been established in 2011, and that was the first thing creating a European environment which will be or can be a cornerstone of a CMU. But we had to learn that that is not enough, and for the Eurozone we had even to strengthen all these approaches with the ECB as a supervisory authority for the largest banks in the Eurozone, and the 3 pillars of the banking union, which is, according to my understanding, not a part of the CMU, as CMU is a EU-wide and not a Eurozone-wide approach. So we will always have this problem that with banking union we have a deeper integration than we will have on the capital markets itself on European level. And this gap should not be too large that there's no chance to overbridge it for those in, pre-ins, outs, which are the 3 possibilities of states for the moment in the European Union in this part of our legislation, and especially that the gap between the ins and the pre-ins is not too large, that there's a chance to overcome it. And I think CMU can be one of those ways of keeping Eurozone and European Union closer together than it was in the past. Of course, we did this famous MiFID regulation. I will not speak about that in detail, only telling you that we, for the moment, take a lot of care what is ESMA doing in its advice to the Commission and preparing regulatory technical standards, what is Commission doing in preparing delegated acts, and we do it for other files as well. As we learned, it's not only to achieve agreements between Parliament and Council and then leave it to the wisdom of the institutions, the bureaucrats, but as well to take care that the spirit of what has been decided between Council and Parliament is safeguarded in level 2 and not jeopardized by level 2 measurements. And that is an exercise we do extremely intensive for the moment, but I think it makes sense that what has been agreed politically is safeguarded on all these level 2 measurements as well. I think, only to remind you, we did a lot in infrastructure issues like EMIR and market abuse, MAD, MAR, to remind that. Of course, MiFID as the cornerstone for the financial markets itself, to fulfill the G20 obligation from Pittsburgh. So we did it not in proper time as agreed in Pittsburgh, but I think we delivered. No unregulated market, no unregulated product. Only to remind you what was the homework G20 has given to all financial markets. So I think we done a lot. Level 2 legislation I have spoken about. I will not speak about money market funds, as that is such an important dossier that I'm happy that Brian is here to give some light in that. But of course we have to address the issue of what is called shadow banking sector, and MMFs are defined as being one of the part of that. But on the other hand, we will address this even in a broader approach, and I don't know whether it makes sense always be behind the developments on the markets. So identify what is going wrong and then make a regulation. It's my understanding of this industry is that it's very innovative and always finds the loopholes legislators are able to create or have forgotten to rule out. And one of my headlines in negotiating the MiFID file was, we do MiFID II to avoid MiFID III. Yeah, and to have that in mind, keep all the leftovers for the next round. The leftovers are the problems in the years to come. And I think that is what has been taken into account carefully when we speak about financial market regulation. And the last thing I wanted to mention is the reform of the banking sector, which is one of those leftovers after the DCAN report, which was, I think, in 2011. And we have now a wonderful discussion in our committee, Brian, whether we have addressed the problem too big to fail already with existing legislation, or whether further steps and measurements have to be taken. I have the feeling that's not a question of where you can identify the truth. I have, following the discussions in our committee, the feeling it's more an ideological issue, and sometimes my understanding is with ideology you are not able to solve problems, and I hope we can come back to a pragmatic approach. But that is only the overview what we are doing, and then of course CMU, which will start with a green book, where of course the European Parliament will make a report on that and give some advice, because the green book is foreseen that a discussion is going to be started with all stakeholders, and I think the European Parliament is a stakeholder council as well, the market, and then to develop further steps onwards to have a better integrated financial markets. And that is the last thing I want to raise in my first remarks, especially the experience I made with MiFID and having the chance to discuss a lot of these issues with our friends in the United States, where Dodd-Frank addresses same problems but solve it in a different way, like we do with our legislation, and at the end we have to organize that this different approach is brought together, that really a financial market and global level can be established, as we learned from our experience 2008 onwards, that is really a global market and regional, and in this case regional is not Bavaria for me, in this case regional is European rules are not addressing all the problems, and we have to cooperate. And the last month worked or had the possibility to meet a lot of people from Asia who really ask us, please come to a common approach between United States and the European Union. I thought in the first round they will do a kind of cherry picking, trying to understand what Dodd-Frank does, what European regulation does, and then to try to catch the best solution for them. But their understanding is they want to be present on both markets, and they want to have a one-rule-fits-all approach. So CMU is, even my understanding, to be seen that we have a strong European financial environment or level playing field, or however you want to name that, which is linked to the other huge financial market to be the answer for the third one, the third great financial market on the Asian area. And if we are able to create that with our special European approach, then we are on the right track. So this legislative period will be once again one where a lot of things in this area are going to happen. And of course, we are ready to take our burden and to deliver. Thank you very much.
Thank you. Brian, I'll pass it straight over to you.
Well, thank you very much indeed, ladies and gentlemen. It's good to see so many people here at lunchtime to talk about money markets reform and everything in between. And just taking up one of the points that Marcus has just referred to, I mean, no matter where you live in the world right now, after the enormous crisis that we have gone through since 2008, we do need a new international standard concerning all of these issues. Now, the solution continent to continent may not be the same, but I do think that the principles underlying the solutions that we find have to be on an international standard. And that's where the issue of money markets reform neatly fits into this debate, because at one level, this is a 1.3 trillion euro market in Europe. It's an extraordinary amount of funds that are used on an annualized basis for essentially large-scale institutional investors here in Europe, governments, and also there is a retail market there as well. But in ensuring that we get the right regulation here, and ensuring that we actually produce a result, we've got to ensure that we don't lose some of that funding to Asia, to the United States, and elsewhere. And I think there is a kind of dichotomy here between, at the one hand, trying to produce a deeper, more integrated capital markets union, which is the objective for this Commission and for our mandating Parliament, while at the same time producing legislation which will have a detrimental effect on the ability of European-wide business to use these funds. And that really is the contradiction that we have got to address in framing our legislation on money markets reform and elsewhere. Where are we on relation? I mean, I think it's fair to say this has been a controversial file, being very frank and upfront and honest about this. It's a file that has bridged the work of Econ in the last Parliament and indeed this Parliament. But I think it was the right decision of Econ when in the last Parliament they decided to put the brakes on the proposal to look at exactly what the SEC in the United States of America produced. That was the right course of action to follow, because if we are going to produce a regulation which is robust and strong and deals with the issue of systemic risk, it has to be done in a context. And that context is very much seeing what way the Americans responded to this. So I think it's been useful that we paused. We now know the way the Americans are on this issue. The Americans have produced their regulation, some of it not coming into operation for another 2 years at least. But the net impact of the US regulation will be a change to about 8 or 9% of the total industry. So they spent a very long period of time with very substantial consultation with industry. They have produced a new regulation, but the net impact of that regulation is no more than about 10% in real effect. So that's useful that we have that piece of work there. And in the work that we've been doing as shadow rapporteurs, working with Nina Gill, our rapporteur, we have taken very close interest in the procedures behind the SEC decision of July of last year. Money markets matter because it affects European-wide business. As I said, a very substantial amount of money exists, and we've got to make sure that those funds stay within the European Union if capital market means anything. Now, I do think we have got to deal with this issue. I mean, Marcus spoke about, saying that this should be a result now rather than having Money Markets 2 or Money Markets 3. I mean, I want Money Markets 1 and that's the end of it, quite frankly. I've more of a life to lead after Money Markets reform. So I'm planning in working with other colleagues and producing a Money Markets reform package which resolves this issue, which deals with the issue of systemic risk and makes sure that we have a fit-for-purpose regulation which doesn't have overspills and difficulties in other member states where this is not the same predominant issue as it is in others. I also believe it's important that the different aspects of the industry are kept. We have, as you know, a VNAV industry and a CNAV industry. I've described this recently to a French colleague as a bit like looking at two cattle in a lovely Irish field. They might look the same, but they're not really the same. And the milk they produce is the same, but very often they're different about what they can produce. So my point is that in keeping the industry together, in making sure that we actually retrofit the industry to make it safe and to make it fit for purpose, we've got to also keep both parts of that industry. That's my strong belief. It will not be helped by knocking out, say, for instance, CNAVs, because if that is done, there is no guarantee that all of that will translate or go into VNAVs or will stay in Europe. Wouldn't we look very stupid if we decided to knock out an entire section of industry and find that the great majority of those funds go to Asia? Wouldn't we look very stupid when we're talking about Capital Markets Union if the very first legislative act we do in this new Parliament is to achieve that? So I think sensible minds need to be brought to bear here. And I've been working very closely with Nina Gill, who is our shadow. It is coming to a head. We'll be voting on this issue on the 24th of February, which is coming up very shortly. And then Parliament will hopefully decide this matter at plenary in the March period. And then hopefully we will have a sensible regulation which Council can amend or support, but ultimately a regulation that works. It is worth saying that Council have not come to an opinion on this. It has been part of a fraught debate. And one thing I very much agree with Nina Gill is, I think we as Parliament can actually produce something that will stand the test of time, something that works something that resolves the issues that I spoke about earlier, but equally something that fits into an international standard that we can be proud about. And I think that's something that we can achieve. So we will see over the course of the next few weeks if we can achieve that. We have in the United States of America essentially a money markets funds that's divided up between a retail sector, a government bond or government sovereign debt sector, and an institutional sector. But unlike the United States of America, the European market is heavily skewed in favor of institutional investors, big businesses who use these funds effectively to park money for a period of time so that they can use those funds in terms of cash flow purposes. What we need to do, in my view, is to extend retail and government debt markets within the European Union. I think that would make sense. And what we're trying to do in the amendments that we have framed is to achieve that. For instance, I don't believe it's viable that we could have a European debt market, as is the case in the United States of America, simply because there's only 6 countries of LVNAV, whereby I've addressed the issue of systemic risk in producing amortized cost accounting, which I think is a much more solid way of addressing this problem of risk that people have spoken about. It's equally important to say, we have one example in the world, just one example, where famously the book was broken by the US example. And then in that case, it was 99 cents that was ultimately given, and funds were not lost to the state as a result of the bailout that occurred. We have no case in Europe of where any of money market funds have actually broken the book or broken the euro, as it is the case. So I think we need to keep that in mind. What I've said is we need a package built around the retail sector, the government debt sector, and the institutional sector. We also need to do things on liquidity. We also need to improve diversification procedures and transparency. So there's a package of measures that we're working on, which taken as a whole, in my view, will produce a much stronger industry into the future without losing those funds to the east or to the west of us. And I think if we can achieve that, it will be something worthwhile. My final remark is this. This file has gone on for a long period of time. As I said earlier, it has abridged a number of econ committees. And I think if we can produce something that is workable, if we can produce something that the industry can use while dealing with the issue of systemic risk, I think that will be a good day's work. And I think we might be able to get there as a result of the engagement that we are having with Mrs. Gill, who's done a good job in trying to bring people together on this. Thank you.
Thank you, Brian.
Thank you.
I just want to thank Marcus and Brian for giving us, I suppose, an update and a view as to what's going on in the Econ Committee in the Parliament. Now I'll pass straight over to Mrs. Fabregas-Fernandez for a Commission viewpoint on these issues.
Yes, thank you, and thank you for inviting me to this event, and good afternoon, ladies and gentlemen. So, as it has been mentioned, during the last 5 years, the Commission put forward many proposals, keeping busy the co-legislators in order to adopt them, and it has been a successful exercise, linked mostly to the financial crisis and to what Mr. Ferber mentioned, this Pittsburgh Declaration, the G20 commitments that we were speaking about. Most of these texts have been adopted by the co-legislators, and we are already working very hard and intensively on the relevant implementing measures. This is in my case. I'm dealing with the Markets in Financial Instruments Directive, Markets Review Regulation, so we are really working hard on these measures in order to, I would say, restore confidence in these markets, because the confidence was lost given the fact that some rules were missing in some areas, and that's what we have tried to put forward in the new legislation. Now, the level 2 measures will specify further the elements in a proportionate manner, and I can confirm that they have to fulfill the political objective of what the co-legislators agree. There are other texts that are still under negotiation, such as the case of the money market funds or the benchmark regulation, for which I'm also in charge, which again is a file where, on benchmarks, there was evidence in the market that something was not functioning. Therefore, it was necessary, in order to restore confidence in the markets, to put forward a proposals to deal with the issue. And on this one, the co-legislators are working on. So this was in kind of this framework of financial stability, restoring confidence. But now we are entering into this new phase, the new phase of capital markets union, which means taking stock of what we have done. Our capital markets really help to create this growth and jobs, and this means to make sure that all the legal framework and other measures that exist and are coming, forthcoming measures, create a dynamic, diversified, resilient market for the future. So, as it has been mentioned, and I have to refer to what my Commissioner Hill, has said already publicly in some events, and Vice President Katainen mentioned last week in a press conference, that this initiative is a real single market initiative. It's 28 member states, as has been mentioned by previous speakers, and this is the core of the issue. We need to make sure that these markets work in the 28 member states, that these markets are sufficiently integrated in order to make sure that liquidity that exists in some markets, in some member states, could say, can help the purpose of creating growth and jobs also in other member states where this is necessary. But of course, always with the necessary warranties for the investors and appropriate protections. So, as it has been said, this Capital Markets Union is linked to the investment plan initiative that was presented last year. And in that investment plan initiative, already some of the measures that this Capital Markets Union will include had been listed. And I can think, for instance, on one area on which we are already working, which is the review of the Prospectus Directive. As you know, in order to issue or to launch public offers, you need a prospectus, and now we are kind of assessing, and this will be through a public consultation that will be launched at the same time as the Green Paper on Capital Markets Union, whether the relevant requirements are proportionate for today's markets, whether the need to have a prospectus is really fit for the purpose of this prospectus in order to make these markets, again, as I said, more dynamic, diversified, and resilient, while introducing a certain level, an appropriate level of investor protection. And what is also important when we speak about Capital Markets Union is that it is not linked only to SME financing. As you know, there have been also in the last 5 years some initiatives that were focusing on SMEs, but then through the negotiation of specific pieces of legislation, for instance, MiFID, our SME concept in MiFID is not the SME, small, medium-sized companies that appears in this recommendation that exists in the Commission that it's used for state aid, but in the MiFID framework, we speak about companies with market capitalization before 200 million. Therefore, we are talking already about mid-caps. And it's absolutely necessary, as we have seen in most member states. And I'm coming from Spain, and we see there that the job creation comes precisely from these mid-caps, SME companies that in some countries, such as was the case in Spain, and some of you can confirm here, were trying to get the financing only from the banks. Now it's necessary to diversify the choice, the toolbox that these companies could have in order to have the necessary financing to grow and to create jobs. Just to finalize on this, as you know, and it has been mentioned, the Green Paper will be published around mid-February, around the 18th. And from there, this will be, as it said, a green paper calling for views from all relevant stakeholders, and in particular also institutions such as the European Parliament. And there will be description of several possible actions. Some of them will be short-term in the sense of quick actions, such as the prospectus, as mentioned. High-quality securitization is another of the initiatives. There will be other items for which further assessment will be necessary. But in any case, in the relevant action plan that will follow the green paper, there will be a kind of timetable with regard to the relevant initiatives. Because, well, as you know, the goal is to developing this capital markets union by 2019. We see several years, but we have to start now in order to build really the foundation of this capital market union, which the foundation is already there with all the legislation that we have in place, but now it's absolutely necessary to make sure that it works for the creation of growth and jobs in the union. And as it has been mentioned, very important also to make sure that the capital markets union becomes an area focused for investment from the outside, from the other regions in the world that now have more liquidity, let's say, to invest. So that's what I would like to say now as a preliminary statement on capital markets union. Thank you.
Thank you very much. Diego, I come to you now. We've heard from, I suppose, from the Parliament and from the Commission about all the work that's been done and the work that's going to be undertaken. But in your view, is this, this goal of capital markets union in 2019, is this just another kind of timetable that the EU is going to miss? What really should the EU focus on?
I guess we will find out very soon. I will not be able to give you more bucolic images about the capital markets union, how this will play out with banking union. But what I think is very important that we do understand how capital markets union is complementary to some extent to banking union, even though it's targeting a broader range of countries around Europe. The big question here is that why do we need a capital markets union, which I think has not really come out yet from this discussion. I think there are at least two dimensions. There is the macroeconomic dimension of it, which is essentially, we have learned from this crisis a better quality of financial integration improves systemic stability and it creates basis for growth. And we have learned essentially that building financial integration only on interbank loans will essentially be more prone to understop and to systemic instability. There is also the risk of having less risk sharing. So if you don't have a market mechanism, you'll have a less risk sharing, which will shift the political burden on fiscal policy coordination. And fiscal policy coordination and sharing, we know it's quite a big topic in Europe that doesn't get solved very easily. So risk sharing is important, therefore we need capital markets to integrate the banking system. There is also the microeconomic dimension. We know that there is a structural gap in funding, especially small and medium enterprises by the banking system, because there is information flows, problems, because the SMEs do not want to disclose information about business plan when they are small. So there is a critical failure in terms of access to finance for small and medium enterprises that are the backbones of economies like Italy and Spain, and among the others, of course. There is an element of lack of internationalization in our banking system, just because there is not enough competition from alternative funding sources. So we ended up with a banking system that are very much national, not international, and therefore it is creating two problems. First, cost of capital, which is on average higher than other regions in the world. And we do not have a very competitive environment in terms of access to finance, which creates also competitiveness issues on a global scale. So this is, I think, quite solid reasons why we need a capital markets union, and why, for me, capital markets union is not just a financial service action plan 2.0, but it's rather institutional and regulatory. And I'm saying that because while going through the reason why we need a capital markets union, a lot of keywords come back: unbiased, fragmentation, which are essentially the same issues that we're trying to face and solve in the banking union discussion. Why? Because even a security is a credit, is a claim, financial claim. And therefore, in order for investors to invest cross-border, they need to have certainty about the transaction. So they need to know who is the supervisor in charge when there is a cross-border problem about payments, who ultimately will respond, and how will this counterpart respond if it doesn't pay. And certainly, you need to have a common ground of investor protection rules that ex ante can be discounted by the investor when they invest cross-border. So these three pillars are, by chance, more or less similar to what we're talking about in banking union. Supervisory mechanism, deposit guarantee scheme versus minimum harmonized level of investor protection rules, and resolution insolvency procedures that allow the investor to know ex ante how, if there is a problem with payments cross-border, how this money, he will get back the money. So essentially what I think the Commission should target and still do not see in this leaked plan is a structural approach which targets pillars, structural reforms, rather than a shopping list of things that are there left over from the G20 discussion. Capital Markets Union is a peculiar European issue. There's nothing to do with the G20. And if we try to build something on bases that are not solid enough, we end up, I guess. If we harmonize these three, we will get rid of the current fragmentation, which is harming the capital markets union at the moment. We have essentially financial markets split along national lines. Today, the maximum you can see is a bit of pan-European competition on secondary trading only, and only on most liquid shares, which is about the first 50 of the FTSE 100. So this is not competition. And we do not see also competition in terms of asset management. We see asset management industry very much fragmented. The average size of investment funds is very low and is not compatible with a single market in terms of costs, in terms of efficiency, in terms of providing tools for long-term investments, infrastructure investments, and so on. So we need to get rid of this fragmentation, and I'm afraid that this does not come just by tweaking a bit the financial regulation, but rather targeting three pillars that needs to be developed in the next 5 years. Now, how to do it, how to make the UK like this type of approach, that's another story, but I will go rather for something that is more politically viable in the long term, rather than something easy to sell in the next 6 months, and then in 3 years' time, 4 years' time, we realize that markets have not progressed and the situation is still as it was in 2015. So that's my, I would say, wish, and I hope the Commission will be more, I would say, brave on this, because I think we need this kind of bravery at this stage.
Okay, thank you, Diego. At this point, I'd like to open questions to the floor. If there are any initial questions, please just put up your hand at this point. Okay, nothing at the moment. I will abuse my position at this point. Just to ask Marcus before you go, and Brian, we've heard Marcus talk about ideological differences in the Econ Committee or in the work of the Parliament. I was just wondering, when it comes to these economic issues, like banking, like money market funds, is there also a geographic geographic division, possibly between the Anglo-Saxons and the Continentals?
Oh, that is really impossible, especially when you speak about money market funds, as we have seen us on the continental side and on the Anglo-Saxonian side. So that is not the issue. Yeah. I think, and you have to be very clear about that. When we speak about creating a single market, we are not in the 17th century where we can do it like a puzzle, bring some pieces together, then we have a wonderful picture. We're in the 21st century, we have well-developed member states. Yeah, they are well-developed and can deliver a lot of answers and have delivered. And on the other hand, to be open-minded, we need a European Commission who should take that into account as well. And only to give you one example, especially when I listened to Diego, the telecom market, I thought, is one of the best developed markets, being a driving force of really becoming a European market and a European infrastructure and European approach. So we tried in the last telecom package to get only one supervisory authority. Member states did not agree on that. They said 28 is better. With this regulation, we have in each member state the obligation, according to European competition rules, that in each member state we have to have minimum 3, in average 4 competitors, which means we have in Europe 28 multiplied with 4 telecom companies, more than 100, for a single market of 500 million users. It's crazy, it's misleading. And to bring that picture to the financial markets, we have something like that as well. So in MiFID we speak about consumer protection. In the consumer protection area we will have a fragmentation of the world, or of the European Union, for a long period. As we had some member states who have decided by themselves that provisions are banned, and only independent advice is allowed. And we have others who have both, and we have a mixture of 28 approaches on that issue. We will never have a European rule on that. So that means all private equity is out of CMU. It will not function because of consumer protection issue. And so to go further and further, that's one of those big challenges we have on European level, that we have a lot of problems, and on the other hand, it's our heritage, it's our richness, and we have to take that into account, what is possible to do on European level, what should be on national, regional, local level, even on those global markets as financial markets. So CMU will be something for professional actors. I think that's a very clear answer. It will be for professional actors. Then you have the second thing, ownership of companies. When I speak with SMEs in my constituency about access to capital markets, the first thing I get as answer is no, because it's my company. I run it. Capital, of course, I take, but I do not share responsibility. Yeah? We have to address this problem. Is that to be solved or not by European regulations? Only to give you some ideas. And of course we have a lack, for example, in risk capital. If you compare our financing system of companies with especially the system in the United States, we have a lack in risk capital and long-term investment capital. And that is something we have to address as well, because according to our own capital requirements, which is CRD4 and Solvency II, especially in Solvency II, we are misleading our insurance companies who are long-term investors. But to go into risk is impossible for them, according to Solvency II rules. So we cannot address it, oh, there's a need, we have to deliver. We have delivered already the opposite. And I think we have to reshuffle rules on that as well, to have an entry point on solving and addressing these problems. A CMU in the first round will not be the all problem-solving issue. It will start with those things which are possible on the European level and have to be done, but it will not be the driving force of really a fully integrated financial market on all asset classes, all clients, all possibilities. It will be linked to a few things in the first round, but that has to be done. I fully support that, because the alternative is the worst, and that is what we see on the Asian side as well, that they are trying to strengthen their cooperation. So our answer can't be to be more diverse than we are today. But let's concentrate on that, what is really needed and what is possible. And if we address these two problems, we are on the right track.
Right.
Well, I agree with Marcus. I mean, there are things we can do today and tomorrow which will help, rather than waiting for the fully integrated capital markets union. And we need to get on and do that, especially on issues like securitization. Will you always find total agreement between 28? No, you will not. That doesn't mean you cannot try, but it equally means that you have to have a framework which will incrementally improve how we can have a more integrated market. And I think that's why it's very important that we get on with the task of capital market union and make sure that those early steps, those early wins can be put in place. You asked the question about ideology. You know, politicians love ideology. They spend great periods of time talking about it.
Not sent to right politics.
No, of course. Far too practical.
We are pragmatics.
We're utter pragmatists. But I think it's very important, and I will say this. In any regulation that we bring forward before our committee and ultimately before Parliament, it should not have a disproportionate effect on a number of member states who have produced and gone forward and built up a significant business, while others haven't. We still are 28. Some countries do things better than others. Some countries specialize in areas of financial markets than others. That doesn't necessarily mean that we need to produce some harmonized regulation which knocks out that competitive advantage. There are things we can do together and things we can do separately, differently. And that's part of the culture, ultimately, of the financial markets of Europe. So I have a very simple rule of thumb. If we are producing something which disproportionately affects 1 or 2 or 3 or 4 countries, we should ask ourselves the question, why are we doing this? Assuming that we have dealt with the fundamental question of risk and how that can be handled. And my last remark, I think it is ultimately really important that, you know, if we're trying to move to the capital markets union, this is going to be a generational shift. The idea that 80% of all lending currently exists between Europe and its traditional old banks and its lenders. You are not going to change that overnight. It will take a generation for that to change. But notwithstanding that, we must have as a priority long-term finance as we move forward. And I think that is, as I fully agree with you, when you say that is one of the net issues we must learn from the crisis, that it's the failure to have long-term investments which has brought us into the position we are in today. If one looks, for instance, at venture capital, how it's compared in the United States of America, yet how it's compared in Europe, we have an awful lot more to learn, I think, from the Americans. Why is it the case that European business sells out much quicker, obtains the profit, gets in and out much quicker? In the United States of America, many of those businesses are built up because of the importance of venture capital. So that's something I think we need to learn as well.
Thank you, Brian. I just want to say thank you to MEP Ferber, who will have to leave us now. Thank you for your contribution, and Capital Markets Union will be a topic that we will return to in the future in the Market Centre. Diego and Mrs. Fabregas, just picking up on something that Brian said there, do you think that, I suppose, moving away from the technical issues, that there is also a cultural change required in Europe? Brian mentioned about venture capitalism. It's a bit of a cliche that the European Union needs to be more like America. You know, why can't we be like Silicon Valley, etc., etc. But is there maybe somewhere in that cliche an actual element of truth?
Well, I think to some extent there is, but I would like maybe to mention Krugman here when he mentioned that there is always the discussion about the confidence fairy tale. I mean, this cultural fairy tale about the fact that Italians are not like the Brits when they go to invest in a security, all this kind of thing. I don't think, I mean, it can be at the margin a bit relevant, but what really matters today are the taxation barriers, the legal barriers that force essentially Italian investors to invest in government bonds, because they are the only instruments that give returns, net returns that are good enough for them to invest their savings and safe enough to invest in their savings. So I think that culture builds up in terms of circumstances. So are the circumstances that make the culture more prone to market access or bank access and so on. So I think we need to get rid also of this misconception about the fact that Italians are different from Spanish and so on. I think that when we talk about an investment, either is a good investment or is a bad investment, what makes an investment good is the transaction costs. So as low as the transaction costs are, the more you will have in terms of cross-border financial flows. And I think that as today, the major issue is how do we reduce cross-border transaction costs, which are the main barrier now for transaction flows. So I hope that what Markus Ferber said is true, that by tackling one pick and choose in the list that the Commission will propose will help Capital Markets Union to develop by 2019. But I bet here today that in 2019 we will sit here again and say why this has not worked out.
So here, this is kind of a comment towards the Commission also, and with the previous remarks by Diego and by the members of the Parliament. So I would like to say that the European Commission is guardian of the treaty, and you all know that one of the key principles in the treaty is the subsidiarity principle. And this has to be respected with regard to any proposal the Commission is putting forward. And there have been examples in the last years about some maybe more ambitious proposals with regard to, I don't know, Mr. Ferber mentioned Telecom One Authority in Europe that didn't pass. And we have to take into consideration that when the Commission will put forward this green paper for consultation, that's the purpose, has to take into consideration the political context and the situation. It's not a theoretical exercise that we are doing here in order to test what is the maximum that in an ideal world we could do. It has to be put on the table in the reality that we have today, taking into consideration legal constraints, economic constraints, political situation in the different member states, in the 28 member states. So that's kind of the framework. Then with regard to your specific question, which is a question that Diego was answering, taking into consideration even some Nobel Prizes remarks. I mean, yes, again, it's true that the environment in the different member states is different, precisely taking into consideration legal framework, historical background, I would say, and the European Union tries to respect these differences because that's the beauty of the EU also. So we need to work all together in order to integrate as far, as much as we can in order to make sure that this capital markets union way works. And this is the purpose, with the main objective of growth and jobs now that are absolutely needed in the EU. But yeah, just to take into consideration that we are working in a Europe that exists today. It's not something that we are inventing, and we need to work from where we are in order to build the necessary steps to go towards the objective, but taking into consideration the relevant constraints. And culture, yes, I mean, important, but taxation, as you said, is what leads also to Italians to invest in debt and others. But, yeah.
Thank you.
Welcome.
I'll try again. Yes, we've got 3 questions here, 2 in the front and 1 about 3 rows back.
Okay, let's assume in 10 years' time that CMU has become a reality. What kind of a player the CMU will be on a global market where 80 families own as much as 3.5 billion people in the world? what kind of a player the CMU will be on that level?
As a consumer and investor, my concern is especially the fragmentation of the market. And my first question really is, do we have to start, if you speak about capital market union of 28, do we have to start in the euro area? Because already there, as Brian said, we have a so-called fragmentation of public debt sector, where really I am as a consumer and investor, I really see this is a shame that the Commission is not proposing, from a certain sense, a common approach. How would, for example, would it be, and I asked really the specialists, would there be a difference in the common interest rate in the euro area if we would change the financing of the European stabilization mechanism from a public ownership of Mr. Schäuble's and the finance ministers to a private, say, financed fund where many savers all over Europe with their savers are ready to invest common bonds responsible by or backed by the European Union, well, they get 3 and 4%. And then we would have never anymore the problem that the European Central Bank is having ashamed that having so low interest rate. No, we would then have, would then be, and this was my question, you just say if there would be a European stabilization mechanism financed by common bonds, backed by a European, say, budget, would there be a higher interest rate? And then would there be savers which are ready, and even assurance and life insurance to invest in such like bonds, while we have a higher interest rate?
Thank you. We'll take one more question.
Yes, I can just follow up on what the kind sir in the first row said on the fragmentation already existing in the EU, in the euro area. Ideological differences and geographical differences have been mentioned, that's fully correct, but if those directives are to further integrate the capital markets union, then my question would be how to deal with those, bearing in mind that we have strong economies like Sweden, for instance, not only the UK that does not use the euro, then we have thriving economies like Poland that does not use the euro. And what also has been mentioned was that there are things we can do together and things we can do separately better. Well, that's also correct, but look at what's happening in Greece at the moment with Syriza and everything, and they do want, if that's my notion of doing things separately, then that's what strikes me as doing things differently, and that's what we don't want if we want to have a strong capital markets union. So finally, my question would be, do those directives actually, would they be attractive to countries that I mentioned before, like Sweden, Poland, and even countries that joined the EU later in 2004 and 2007 to join the Eurozone?
Thank you. I think I'll open, two of the questions were similar, dealing with fragmentation of the markets. So I will open that question to the panel. Brian, do you have any initial thoughts?
I mean, it's inevitable that we currently see this fragmentation. I think there's two big differences now than that which occurred in 2008, in that we have the macro-prudential environment has dramatically changed because of all of the changes that have been made, the six-pack, the two-pack, banking union. The actual, the background that we're talking about now is dramatically different than it was the case in 2007 and 2008. And the enforcement of those rules, I think, makes for a much more, it's a much better environment in which much of this can occur. But even if you take, the 19 states of the Eurozone at the moment, is there any fundamental difference in the level of even inter-country lending or interbank lending between the 19 member states of the European Union. I'm not so certain that there is at the moment, and that's the fundamental question. Are we going to get businesses, big and small, to use a wider, deeper capital market instrument which will come from this process across all of the member states? Maybe there's an argument for saying, for instance, if one looks at the SSM, for instance, which is effectively the new regulatory environment that we all have to work within, it's effectively an environment for the Eurozone essentially, but of course it doesn't prohibit the opportunity for non-Eurozone countries to join. And actually, I'd make a prediction that within the not too distant future that's going to happen, because there's already considerable interest among some non-Eurozone countries for using the gold standard, the gold mark of the SSM as its kind of overall regulatory assessment for the health of the banks in those countries. So maybe that is the way to go, if I can take your question up directly, that there is this framework that people will buy into. It's very ambitious to have this across the 28 member states of the Union, I accept that. On your question about bonds, I mean, I think people will put money into something where they feel not only will they get their money back, but will they have a return. And if an instrument were to be established, which would have a common ownership across a number of member states, assuming that there was a significant backstop there for it, people would be interested in that. It is an interesting concept. It's what you do with that money at the other side, and who guarantees it is the question. And it's not a good environment where there's only 6, as I said earlier in my remarks, there's only 6 AAA countries currently. It doesn't leave to a huge sum of money to guarantee all this stuff, but things will change. I mean, I made a point recently in Parliament that we had a very interesting prediction by Commissioner Moscovici, Katainen and Tyson recently at an econ meeting, where they said this year, people forget this year they made the bold prediction, it will be the first year since 2008 when every member state of the 28 member states will grow. That in itself will provoke a confidence and a certainty that I hope will be able to move the situation forward. So I do think we do need to have products which into the future encourage more lending and encourage more support for government debt. And if that could be by way of common bond, that's a very interesting concept.
Diego, do you want to make a comment?
Tackling this point of fragmentation, I mean, it's precisely because we have a subsidiary action that Neil Kroes did at the European Commission, the competition department. So if we're talking about pushing competition, we can't just abolish cross-border fees here because there's not a telecommunication industry, but we have to create the environment in which these cross-border fees go to zero or close to zero. So if there is no intention to do that because this may harm some member states and so on, this is not in line with the subsidiarity principle in the first place. Because subsidiarity principle says where the member states are unable to do it, the Commission steps in. And this is precisely the case where the Commission has to step in. If it's too afraid to step in, I'm afraid that we're going to be here 2019 to discuss why we're not having capital markets.
But if I may, what I like to say is that through MiFID II, a lot of improvement will happen in these markets. For instance, referring to costs, MiFID precisely tries to introduce some rules with regard to, for instance, the cost of data, with regard to transparency concerning the cost for the investors. So there is a lot there already, a lot that has been achieved in terms of law published in the official journal, but of course not yet applicable because we are developing the delegated acts and it will be applicable from 2017. January 2017. So there are lots of measures that were adopted in the last 5 years that will really help to overcome this fragmentation, and that we have to take into consideration. And just also to say that, as stated at the start, CMU is 28 member states, so it's a single market initiative, and as mentioned also by some, we need to take into consideration that it's a complement to what has been done through the banking union. So it's really important to take these things together, because some people are even saying that this CMU is against the banks. Just the opposite, is in order to growing the whole economy.
So, thank you. I'm Dave. One more question from.
All of these measures is to ensure that surplus savings go from where they're surplus to places where they need investment capital. And I've got two questions, and I think the first question is it possible to go at this by creating a permissive approach, which is to say any financial instrument that is approved and on the market of any country can and should be marketed in everyone else, whatever the financial service. So that at least permits that. The second thing is, what I wanted to do is ask a little bit about the nature of the problem. Is the problem the legal framework, or is it the lack of distribution channels? Is there something a little bit more systemic at question here that maybe the EU can't per se address as a matter of law, but maybe there are other things that need to be done to deepen and broaden the capital markets in member states, particularly those that have been using and should be using the surplus capital?
Great, thank you. Diego, if you want to...
Certainly marketing rules are the big problem here. And I think the fact that you cannot buy, going to your bank, you cannot buy Spanish government bonds, because today if you want to buy Spanish government bonds, you have to go to at least 2 intermediaries that are going to cost you a hell of a lot. So the interest rates are just for the wholesale banks that are able to buy the government bond. This is not happening, so we should wonder what is actually impeding the cross-border distribution of financial products, financial instruments. One of the elements is on the supply side. So the fact that, for instance, the prospectus, as Maite mentioned, is a big problem, especially for small and medium enterprises, or the administrative burdens. But there's an element of demand, which I think is even more important. The cost of buying instruments today that are not domestic financial instruments is too high. So now the question is, why is too high? Well, I made a list of that. And I think if we don't cluster them in big areas, so for instance, the supervisory framework, the investor protection framework, and the resolution insolvency procedures framework, which is not just affecting the investors per se in the financial transaction, but also the infrastructure. The fact that we don't know how an infrastructure can be resolved in a country rather than another creates also issue of consolidation in terms of infrastructures, not just in terms of asset management industry. So these things are all together creating high costs. So it's not about saying we have to bring the moon here and we have to do everything at the same time, but if we don't address the issue by tackling the structural problems that make these transaction costs too high, then I think we're just going in all the directions here. And I mentioned, I think it's important that I think if you see how insolvency procedures to some extent could be important, not just from the side of the investor, but also from the side of the infrastructure, you would see changes immediately. And I think there, if you look at what is happening, is that we also need to have a European framework. And I think that trying to harmonize 28 regimes will not happen. We either introduce a safe harbor clause, and we say cross-border transaction enter in the 29th regime, and we just bypass the national member states. Otherwise, here, I don't think we will never harmonize that. And I think that is a big chunk of this transaction cost. You will never get rid of it.
Mrs. Fabregas, do you want to make any comment? Or
I think that it's very pertinent, the remark about the fact that not everything has to be done through new legislation. Because it's absolutely true that there are areas where maybe the right incentives are not yet there, but it's not through legislation that they might be introduced. So your question was very pertinent in this regard, and concerning this issue of products can be placed everywhere. Well, precisely the legal framework we have is prospectus with a passport should be able to be placed everywhere. MiFID also allowing this trading, but it's not happening. Why it is not happening? So it's a question of assessing further, other elements that exist in the markets that create barriers in a way to this selling of instruments here and there, investing where I want to invest and at the appropriate
Just
cost.
maybe one comment on this. It's not necessarily legislation in this case, for instance, of MiFID, where we had already, also with MiFID I, quite a good harmonization of rules. It's how these rules have been implemented by national financial authorities that is quite sometimes shocking, because the concept of suitability in Spain was that you can actually sell preferred shares to retailers that doesn't know anything about financial markets, and that's, I think, a big problem. So that's why I think it's also an institutional issue. That's why there is also a supervisory element, Capital Markets Union, that needs to be pushed in. And I saw that at the last minute, the Commission has introduced something on the supervisory convergence and the role of ESMA. There is also a big question about the legal status of ESMA. Can actually ESMA be something that can implement Capital Markets Union? Is strong enough to support a Capital Markets Union plan?
No, I think
and
that's the crucial issue. There is no point having a common rule book which is supposed to have application across all of the member states when that is independent, well, not independently, but when it is applied on a different basis in each country. Do we have the confidence that it is being enforced as one would expect? And that, I think, is the fundamental issue. We're talking here about people who have money, which is surplus, as you rightly say. They're not going to invest where there's absolute certainty about the legal framework surrounding that and the treatment of those products. So we either have a common rule book or we don't, and we either have an application of that in the member states or we don't. Yeah. And without that, you are not going, irrespective of the distributional arguments, and I do accept this is around distribution. How are we going to make sure that people can invest in this? But I think unless you get the legal side right first, I don't think people will have the confidence to radically increase that 3% figure that Diego mentioned about.
And just if I may, the issue of the creation of the 3 supervisory authorities was precisely that, in order to make sure that there was a consistent and coherent application and enforcement of the EU law. And this is written in the establishing regulations, so it's absolutely crucial that the authorities play also their role in this regard.
Diego, I'm going to give you the last word on this debate. Okay. Just coming back to an earlier question about if we do have Capital Markets Union, or in 10 years' time, or a lot of the way there, does it have the potential and the possibility to make a huge difference to the European economy, to tackling inequality, as an earlier questioner said, and to creating jobs and growth?
We usually, I think, when we discuss, for instance, about nice things like long-term investments, like risk sharing, they sound very nice. We tend to see, well, we can try now to put a policy proposal that will solve all the issues, so we'll name it long-term, and there will be long-term investment. What I think actually is the point is that are the conditions, all a mixture, a complexity of conditions that make long-term investments viable and coming to a European environment. So I believe that if we tackle the issue as a complex ecosystem in which many pieces of the puzzles have to come together at the same time or close to the simultaneously, I would say that that will create the environment for long-term investments, long-term growth, competitiveness with other financial centers around the world, and because I think Europe can lead investments globally, because it's got the industry, it's got the service industry, and has still a leading role as a commercial partner across the globe. And you know that if you want to have a strong financial system, you need to have a strong regional partner. And that's the case, has been the case for the United States, and it's going to be the case for Europe. But if we believe that we can grow keeping small financial centers or small pieces of trade partnerships on national level, we're not going anywhere, because we have to compete with China, we have to compete with a huge mammoth, I would say, financial system around the globe. And so I don't think we can reach that. So Capital Markets Union can actually give you the tool to compete better globally, to attract flow and to balance the flows imbalances that you will see, that we have seen, not just within the monetary union, but also outside. What is happening now in Denmark because of the PAG and the fact that they are not issuing bonds because of the risk of getting too many capital in, it's also a problem. What is happening with Switzerland, the currency wars and so on. Capital markets can bring also stability in that dimension, which is very important.
Okay, thank you very much. At this point, I just want to thank everybody for coming. I want to thank our speakers for bringing their expertise from the Parliament, from the Commission and from CEPS. I think there's no point in really trying to sum up this panel because we're kind of actually at the start of a process rather than the end. And I'm sure that this is something that the Martin Centre will return to once the action plan has been published. Thank you very much.